On Friday, the January 10th, 2026, the Department of Justice served the Federal Reserve with grand jury subpoenas threatening a criminal indictment against Federal Reserve Chair Jerome Powell. On Sunday night, January 12th, Powell released an extraordinary video statement from the Federal Reserve. He said, quote, "On Friday, the Department of Justice served the Federal Reserve with grand jury subpoenas threatening a criminal indictment related to my testimony before the Senate Banking Committee last June. That testimony concerned in part a multi-year project to renovate historic Federal Reserve office buildings. I have deep respect for the rule of law and for accountability in our democracy. No one, certainly not the chair of the Federal Reserve, is above the law, but this unprecedented action should be seen in the broader context of the administration, threats, and ongoing pressure." Then Powell said the words that sent shockwaves through financial markets. Quote, "This new threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation." Those are Powell's exact words. He called the criminal investigation a pretext. He said it's not really about the building renovation. It's about interest rates. It's about the Trump administration trying to force the Federal Reserve to cut rates faster and deeper than the Fed thinks is appropriate. And Powell ended his statement with this, quote, "Public service sometimes requires standing firm in the face of threats. The markets reacted immediately. According to Fortune magazine's reporting published on January 11th, stock futures fell 0.5 to 0.8% overnight as news of the subpoenas spread. Gold jumped 2%, silver surged 6.2%, the dollar weakened. Investors started pulling money out of U.S. assets and moving into safe havens like precious metals. Christopher Hodge, chief U.S. economist at Natixis and a former principal economist at the New York Federal Reserve, told Fortune that for a full year now the market has heard threats about Fed independence and it consistently shakes them off, but at some point there will be a breaking point. He said, quote, "Straws don't break camels' backs, incremental weight does." Hodge also warned that if Powell is implicated in the probe, then the whole board will likely be implicated as well, resulting in an erosion of the Fed as a credible policymaking institution. This is not normal. In the history of the modern Federal Reserve, going back to 1913 when it was created, no sitting Fed chair has ever been criminally investigated. Not during the Great Depression, not during World War II, not during the inflation crisis of the 1970s, not during the 2008 financial crisis, never, until now. So what's actually happening here? Is this a legitimate criminal investigation into Powell lying to Congress about building cost overruns? Or is this, as Powell himself said, political intimidation designed to force the Fed to cut interest rates and make borrowing cheaper for the federal government, which currently owes $38.45 trillion in national debt and is paying over $1 trillion per year in interest? So what exactly is the Department of Justice investigating? On the surface, it's about the renovation of the Federal Reserve's headquarters in Washington, D.C. The project is a multi-year renovation of two historic Federal Reserve buildings called the Eccles Building and the Martin Building. According to the Federal Reserve's own website, the renovation is necessary to remove asbestos, upgrade electrical and ventilation systems, and consolidate operations so that most Fed employees can work in one location instead of being spread across multiple buildings in D.C. The project was originally estimated to cost $1.9 billion. As of now, the cost has ballooned to $2.5 billion. That's a $600 million overrun. On June 25, 2025, Jerome Powell testified before the Senate Banking Committee about the renovation. During that hearing, Republican Congresswoman Anna Paulina Luna from Florida and Office of Management and Budget Director Russell Vought accused Powell of including luxury features in the renovation. Vought called it ostentatious and said the Fed might be violating the law. Specifically, they claimed the renovation included things like special elevators, a VIP dining room, new premium marble, water features, and a rooftop terrace garden. According to CNN Business and ABC News reporting, Powell denied all of those claims under oath. He told the Senate Banking Committee, quote, "There are no special elevators, new water features, or rooftop gardens." He said the only new marble being installed was to replace broken old marble. He also said the Eccles Building, which was built in the 1930s, had never had a serious renovation before, which is why the project was so expensive. But Congresswoman Luna says Powell lied. On her official House website, Luna published a statement saying she referred Powell to the Department of Justice for the potential crimes of perjury and false statements to federal officials. Luna claimed that official project documents submitted to the National Capital Planning Commission directly contradict Powell's testimony. She also said Powell falsely claimed the Eccles building never had a serious renovation, when in fact there was a major overhaul between 1999 and 2003. Luna wrote, quote, "These are not minor misstatements. Chairman Powell knowingly misled both Congress and executive branch officials about the true nature of a taxpayer-funded project." So that's the official reason for the investigation. Powell allegedly lied to Congress about luxury features in a building renovation and about whether the building had been renovated before. That's what the DOJ is saying this is about. But here's the problem with that story. The Department of Justice opened this investigation in January 2026. The testimony happened in June 2025. That's 7 months later. If Powell had committed perjury in June, why did the DOJ wait until January to open a grand jury investigation? And why did they serve the subpoenas on Friday, January 10th, just 2 days before Powell's term as Fed Chair is set to expire in May? The timing is suspicious. And Powell himself said in his video statement that the building renovation is a pretext. He said, quote, "This new threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. It is not about Congress's oversight role. The Fed, through testimony and other public disclosures, made every effort to keep Congress informed about the renovation project. Those are pretexts. So if it's not about the building, what is it really about? Powell says it's about interest rates. It's about the Trump administration trying to force the Federal Reserve to cut interest rates faster and deeper than the Fed thinks is appropriate. And there's plenty of evidence to support that claim. This has never happened before. In the entire history of the Federal Reserve, which was created in 1913, no sitting Federal Reserve chair has ever been criminally investigated by the Department of Justice. Not during the Great Depression, when the Fed failed to prevent a wave of bank failures. Not during World War II, when the Fed was essentially subordinate to the Treasury Department. Not during the inflation crisis of the 1970s, when inflation hit 14%. Not during the 2008 financial crisis, when the Fed intervened to bail out Wall Street banks. Never. The closest precedent is what happened to former Fed Chair Thomas McCabe in 1951. President Harry Truman wanted McCabe to resign because McCabe supported raising interest rates to fight inflation, while Truman wanted to keep rates low to finance the Korean War. Truman pressured McCabe, and McCabe resigned, but he was never criminally investigated. No grand jury subpoenas, no threat of indictment. He just resigned. The Federal Reserve is supposed to be independent. That independence is enshrined in law. According to the Federal Reserve Act, members of the Board of Governors, including the Fed Chair, can only be removed by the President for cause. The statute says, quote, "Any member of the board may be removed for cause by the President." The key word is for cause. You can't fire a Fed governor just because you don't like their policy decisions. You can only remove them for misconduct, like corruption or incompetence. That's what the Supreme Court ruled in a 1935 case called Humphreys Executor versus United States. The court said that independent agencies like the Federal Reserve must be insulated from political pressure. The president can nominate and appoint members, but he can't fire them just because they make policy decisions he doesn't like. This independence exists for a reason. As former Fed Chair Ben Bernanke explained in a 2010 speech, quote, "Policymakers in a central bank subject to short-term political influence may face pressures to overstimulate the economy to achieve short-term output and employment gains that exceed the economy's underlying potential. Such gains may be popular at first and thus helpful in an election campaign, but they are not sustainable and soon evaporate, leaving behind only inflationary pressures that worsen the economy's longer-term prospects." In other words, if the president can control the Fed, he'll force the Fed to cut interest rates before every election to juice the economy and help him win re-election. But that creates inflation, which hurts everyone in the long run. That's why the Fed is independent. It's supposed to make decisions based on economics, not politics. Richard Fisher, the former president of the Dallas Federal Reserve Bank, said this DOJ investigation is lawfare at its worst. He told Newsweek, quote, "Using the Justice Department to go after the Fed chair is unprecedented and deeply troubling. It undermines the credibility of both institutions." Justin Wolfers, a University of Michigan economist, posted on social media that attempting to criminalize monetary policy is an outrage against the economic and political foundations of a free and prosperous society. Christopher Hodge, the former New York Fed economist now at Natixis, told Fortune that this could be devastating for the stock market. He said, quote, "If Powell is implicated in the probe, then the whole board will likely be implicated as well, resulting in an erosion of the Fed as a credible policymaking institution." This is not about a building renovation. This is about whether the Federal Reserve can function as an independent institution, or whether it will become a tool of the White House to manipulate interest rates for political purposes. Donald Trump has been at war with Jerome Powell for years. Trump appointed Powell as Fed Chair in 2018 during his first term. But within months, Trump regretted that decision. In 2018 and 2019, Powell raised interest rates to cool down the economy. Trump wanted lower rates to juice growth before the 2020 election. Trump called Powell clueless, a bonehead, and an enemy of the country. He said Powell had no guts, no sense, and no vision. At one point, Trump asked his advisors whether he could legally fire Powell. The answer was no. Under the Federal Reserve Act, you can only remove a Fed governor for cause, meaning misconduct. Policy disagreements don't count. But Trump never stopped trying. During his second term, which started in January 2025, Trump ramped up the attacks. In April 2025, Trump called Powell Mr. Too Late and a major loser on Truth Social. He demanded preemptive cuts in interest rates and said the economy could slow down unless Powell lowered rates now. In November 2025, Trump said at the U.S.-Saudi Investment Forum, quote, "I'd be honest, I'd love to fire his ass." He told Treasury Secretary Scott Bessent to work on Powell to quickly lower rates and quipped, "The only thing Scott's blowing it on is the Fed. The rates are too high, Scott, and if you don't get it fixed fast, I'm going to fire your ass." Trump also recited a fake conversation in which Bessent supposedly begged Trump not to fire Powell. Trump said, "I can't tell you." Scott says, "Sir, don't fire him. Sir, please don't fire him. He's got 3 months to go. Don't fire him. I want to get him out." Trump added that Commerce Secretary Howard Lutnick is a little bit more for firing. I think Howard would say, "Get him the hell out." Trump even announced something he called the Trump Rule on Truth Social. He wrote, "I want my new Fed chairman to lower interest rates if the market is doing well, not destroy the market for no reason whatsoever. The United States should be rewarded for success, not brought down by it. Anybody that disagrees with me will never be the Fed chairman." So why is Trump so obsessed with lower interest rates? 2 reasons. First, political. Lower rates mean cheaper mortgages, cheaper car loans, cheaper credit cards. That makes voters happy. And happy voters vote for the incumbent. Trump wants the economy booming before the midterm elections in November 2026. Second, fiscal. The United States owes $38.45 trillion in national debt. Interest payments on that debt are over $1 trillion per year. When the Federal Reserve raises interest rates, the government's borrowing costs go up. New Treasury bonds have to pay higher yields to attract buyers. That means more interest, which means bigger deficits, which means more debt. It's a vicious cycle. Trump needs low rates to reduce the government's debt service costs. If the Fed keeps rates high, interest payments could spiral out of control. By some estimates, interest could hit $2 trillion per year by the end of the decade. That's money that can't go to tax cuts, defense spending, or infrastructure. It just goes to paying interest on past borrowing. So Trump has a huge incentive to pressure Powell into cutting rates. The problem is Powell won't do it. Powell's term as Fed chair expires in May 2026. Trump is expected to nominate a new chair in January, possibly National Economic Council Director Kevin Hassett, who has argued for aggressive rate cuts. But until May, Powell is still in charge, and Powell isn't budging. At the Fed's December meeting, the Fed cut rates by a quarter point, bringing the benchmark rate to a range of 3.5 to 3.75%. But Powell signaled that further cuts would be slow. The Fed's dot plot, which shows where individual members expect rates to go, indicated only one more cut in 2026. Trump wants much deeper cuts. He wants rates below 3% or even lower. Powell is saying no, and Trump can't legally fire him. So what does Trump do? It's lawfare. Use the criminal justice system to intimidate a political opponent into compliance. The markets reacted immediately to Powell's announcement. According to Fortune magazine, when investors around the world woke up Monday morning, January 12th, to the news that the DOJ had subpoenaed the Federal Reserve, it rekindled fears about whether America was still the gold standard for investment. The result was what traders are calling a sell America market. Stock futures fell 0.5 to 0.8% overnight. Gold jumped 2% to around $4,578 per ounce. Silver surged more than 6.2%, hitting a record high of $86. The US dollar weakened against every major currency, including the Swiss franc, Japanese yen, euro, and British pound. According to NBC News reporting, the IC US dollar index, which measures the dollar against a basket of foreign currencies, dropped 0.3% by 4 p.m. Eastern Time on Monday. Yields on U.S. government bonds soared to their highest level since September 2025. The 10-year Treasury yield rose above 4.2%. The 30-year Treasury yield, which is viewed as a barometer of future inflation expectations, rose above 4.8%. Those are danger signals. When bond yields go up, it means investors are demanding higher returns to hold U.S. government debt. That suggests they are worried about inflation or they're losing confidence in the government's ability to manage its finances. By January 13th, according to Financial Contents reporting, gold had shattered the $4,600 barrier and hit a new all-time record high of $4,612 per ounce. That's a 65% gain since the beginning of 2025. Silver hit $93 per ounce. Precious metals mining stocks soared. Newmont Corporation crossed $100 per share for the first time. The SPDR Gold Shares ETF, ticker symbol GLD, saw massive inflows as investors rotated out of stocks and into gold. This is the sell America trade. When investors lose confidence in U.S. institutions, they sell U.S. assets and buy hard assets like gold and silver that can't be devalued by political decisions. The same pattern happened in April 2025 after Trump announced his Liberation Day tariffs. Stocks fell, gold and silver surged, the dollar weakened. Moody's downgraded the U.S. credit rating. And now it's happening again. Strategists at ING Bank wrote in a client note on Monday that Powell has explicitly characterized this as an attack on the Fed's independence from the Trump administration. The combined drop in the dollar, equities, and treasuries was a reminiscence of the Sell America days of last spring. Christopher Hodge, the former New York Fed economist now at Natixis, told Fortune that for a full year now, the market has heard threats about Fed independence, and it consistently shakes them off, but at some point there will be a breaking point. He said, straws don't break camels' backs, incremental weight does. The question is whether this DOJ investigation is the straw that finally breaks the camel's back. JP Morgan strategists wrote to clients that the Sell America theme may be the dominant narrative in the short term. They warned that concerns around Fed independence offer reason for caution. Even though stocks recovered some of their losses by the end of Monday and closed slightly higher, the surge in gold and silver paired with pressure on the dollar and treasuries is a signal that Wall Street is bracing for volatility. According to CNN Business, investors might think efforts to undermine the Fed's independence will fail. But the surge in gold and silver paired with pressure on the dollar and treasuries is a signal that Wall Street is bracing for volatility in U.S. markets. Fed independence is considered a cornerstone of what makes U.S. financial markets exceptional. Analysts at HSBC have already raised their 2026 gold price targets, suggesting that if the political deadlock continues, gold could test the $5,000 per ounce level before the end of the second quarter. That would be another 9% gain from current levels. Now let's connect the dots between this DOJ investigation and the bigger crisis. The United States owes $38.45 trillion in national debt. According to the Congressional Budget Office, the federal government borrowed $601 billion in just the first 3 months of fiscal year 2026, which started in October. Interest payments on that debt are over $1 trillion per year. And here's the key. When the Federal Reserve raises interest rates to fight inflation, the government's borrowing costs go up. Every new Treasury bond issued has to pay a higher yield to attract buyers. That means more interest, which means bigger deficits, which means more debt. It's a vicious cycle. And Trump knows this. He needs low rates to reduce the government's debt service costs. According to economist Tyler Cowen from George Mason University, the real problem is that Fed independence was already doomed the moment debt got this high. In an interview on the TBPN Technology Show, published by Fortune on January 13th, Cowen said, quote, "The basic problem is our debt and deficits are so high that over time we will monetize them to some extent and have higher inflation because we prefer that over higher taxes, no matter what we might say." Cowen argues that even without overt political pressure, a heavily indebted democracy limits its own monetary choices. At some point, inflation becomes the least politically painful way to manage obligations that voters are unwilling to finance through taxes or spending cuts. This is exactly what former Fed Chair Janet Yellen warned about on January 4th. She said, quote, "The preconditions for fiscal dominance are clearly strengthening. Fiscal dominance is the point at which the government's debt becomes so large that the central bank can no longer control inflation without risking a government default." Former Fed Chair Ben Bernanke explained it in a 2010 speech. He said policymakers in a central bank subject to short-term political influence may face pressures to overstimulate the economy to achieve short-term output and employment gains that exceed the economy's underlying potential. Such gains may be popular at first and thus helpful in an election campaign, but they are not sustainable and soon evaporate, leaving behind only inflationary pressures that worsen the economy's longer-term prospects. In other words, if the president controls the Fed, he'll force rate cuts before elections to juice the economy. But that creates inflation, which hurts everyone in the long run. And here's the irony. Trump is trying to pressure Powell into cutting rates to reduce the government's interest payments, but the markets are already reacting to that pressure by demanding higher yields on Treasury bonds. According to NBC News, the 10-year Treasury yield rose above 4.2% on Monday, January 12th. The 30-year yield rose above 4.8%. Why? Because investors are worried about inflation. They're worried the Fed will cave to political pressure and cut rates too soon. And they're worried the government will try to inflate away the debt by letting inflation run higher. So they're demanding higher yields as compensation for those risks. It's called a term premium. And when term premiums go up, borrowing costs for the government go up, which defeats the entire purpose of pressuring Powell. Ray Dalio, the billionaire founder of hedge fund Bridgewater Associates, has been warning about this for years. He calls it the big cycle debt trap. When debt gets this high, the government becomes trapped. If it raises rates, interest costs explode and the deficit spirals. If it cuts rates, inflation rises and bond markets revolt. Either way, the government loses. Eric Leeper, a University of Virginia economist and former Fed official, told Fortune on January 5th that for most of American history, the U.S. operated under the Hamilton norm, the expectation that any debt issued today would be fully financed by future tax surpluses. That norm, Leeper said, died in 2020. Trump put his name on the checks that went out to people during COVID. Biden did the same, nearly $5 trillion in spending. And Congress and the White House no longer even give lip service to the idea of future surpluses. Leeper said, quote, "America always does the right thing after exhausting every other option. Until that faith really gets shattered, we're okay. But if that starts to get shattered, then we're really in deep doo." So here's where Trump's plan completely backfired. The DOJ investigation was supposed to intimidate Powell into resigning early. Instead, it made Powell more determined to stay. According to prediction market Kalshi, before the DOJ announcement, bettors gave Powell an 85% chance of leaving the Federal Reserve before August 2026. That made sense. His term as Fed Chair expires in May. Most people assumed he'd step down, leave Washington and retire, or join the private sector. But after the DOJ served subpoenas on Friday, January 10th, those odds collapsed. By Monday, January 13th, Kalshi showed only a 55% chance that Powell would leave before August. That's a 30-point drop. The market now thinks Powell is more, not less, likely to stick around. And here's why that matters. Powell's term as Fed Chair ends in May 2026, but his term as a governor on the Federal Reserve Board doesn't end until January 2028. Under the Federal Reserve Act, the president can appoint a new chair, but he can't force Powell off the board unless Powell voluntarily resigns. So even if Trump nominates someone like Kevin Hassett or Kevin Warsh to replace Powell as chair in May, Powell could stay on the board for another 20 months. And if he does, he gets a vote on every interest rate decision. He's not just some retired former chair. He's a sitting governor with full voting power. That means Powell could spend the next 2 years publicly resisting Trumpist pressure for lower rates from inside the Federal Reserve. According to CNN Business, economists and former Fed officials think the DOJ investigation has made Powell more determined to fight back. Tim Mahidi, a former San Francisco Fed official who's now CEO of Access Macro, told CNN, "Trump isn't going to win this. Powell isn't one to be pushed around. They're not going to cut rates in January." Justin Wolfers, the University of Michigan economist, said, "Attempting to criminalize the conduct of monetary policy is an outrage. Every American should oppose this. Bad economics, bad politics, bad for the rule of law, bad for markets." Even Treasury Secretary Scott Bessent, according to a source who spoke to CNN, is unhappy with the decision to prosecute Powell. Bessent reportedly told people privately that he disagrees with the DOJ move. And here's the other backfire. Republican Senator Tom Tillis from North Carolina, who sits on the Senate Banking Committee, announced he will block confirmation of anyone Trump nominates to replace Powell until the DOJ investigation is fully resolved. That's a huge problem for Trump. Even if he picks a new Fed chair nominee in January or February, the Senate won't vote to confirm that person as long as the criminal investigation is active. So Trump is stuck. He can't force Powell out. He can't get his replacement confirmed while the investigation is ongoing. And Powell is now more motivated than ever to stay on the board through January 2028, just to resist political pressure. Douglas Holtz-Eakin, president of the American Action Forum, a center-right think tank, called the whole thing a really unwise and boneheaded move. He told the media, "This is really stupid." The FOMC meeting on January 28th is now the most important Fed meeting in years. Markets are pricing in a 95% probability that the Fed will hold rates steady. Why? Because cutting rates now would look like the Fed is caving to DOJ intimidation. Powell and the other governors don't want to send that signal. So they're expected to hold rates at the current range of 3.5 to 3.75%, even if the economic data might justify a cut. It's a fortress position. The Fed is signaling that its policy is determined by data and economics, not by the Department of Justice. But that strategy carries risks. If the economy slows and the Fed refuses to cut rates just to prove it's independent, unemployment could rise and the slowdown could deepen. That would give Trump more ammunition to say the Fed is sabotaging the economy for political reasons. It's a no-win situation. And it's all because Trump tried to weaponize the DOJ against the Federal Reserve. So here's where this gets really interesting. Trump's plan to intimidate Powell into resigning just backfired. According to prediction market Kalshi, before the DOJ investigation was announced, Bettors gave Powell an 85% chance of leaving the Federal Reserve before August. That made sense. His term as Fed Chair expires in May. Most people expected him to step down and leave Washington. But after news of the criminal investigation broke, those odds plunged to just 55%. The market now thinks Powell is more, not less, likely to stick around. Why? Because Powell doesn't want to look like he's caving to political pressure. His term as Fed Chair ends in May, but his term as a governor on the Federal Reserve Board doesn't end until January 2028. That means even if Trump appoints a new chair in May, Powell could stay on the board for another year and a half. And if he does, he'll have a vote on every interest rate decision. He'll be a powerful voice for Fed independence sitting right there in the room. Douglas Holtz-Eakin, president of the American Action Forum, a center-right think tank, called Trump's DOJ investigation a really unwise and boneheaded move. He said, "This is really stupid." Tim Mahidi, a former San Francisco Fed official and now CEO of Access Macro, told CNN that Trump isn't going to win this. Powell isn't one to be pushed around. They're not going to cut rates in January. And here's the other backfire. Republican Senator Tom Tillis, a member of the Senate Banking Committee, said he will oppose confirmation of anyone Trump nominates to replace Powell until this legal matter is fully resolved. That means even if Trump picks a new Fed chair nominee like Kevin Hassett or Kevin Warsh, the Senate might not confirm that person as long as the DOJ investigation is ongoing. Trump is stuck. He can't force Powell out. He can't get his nominee confirmed while the investigation is active. And Powell is now more likely to stay as a Fed governor through January 2028 specifically to resist political pressure. The DOJ investigation was supposed to intimidate Powell into cutting rates and resigning. Instead, it's made Powell dig in his heels, delayed the confirmation of a replacement, and sparked a constitutional crisis over Fed independence. Markets are pricing in a 95% probability that the Fed will hold rates steady at the next meeting on January 28th, specifically to demonstrate that the Fed won't be bullied by the DOJ. And bond markets are revolting. Treasury yields are rising. Gold hit a record high. The dollar is weakening. Investors are pulling money out of U.S. assets and moving into safe havens. This is the Sell America trade all over again. And it's all because Trump tried to use the Department of Justice as a weapon against the Federal Reserve. In my previous videos, I've explained how the United States has crossed into fiscal dominance territory. The national debt is 120% of GDP. Interest payments are over $1 trillion per year. The bond market is revolting. And now the president is trying to criminalize monetary policy to force the Fed to cut rates and make borrowing cheaper. It's all connected. The debt, the tariffs, the fiscal dominance, the DOJ investigation. It's one giant crisis spiraling out of control. The next Fed meeting is January 28th. Watch what happens. If the Fed holds rates steady, it'll be a middle finger to Trump and the DOJ. If the Fed caves and cuts rates, it'll signal that Fed independence is dead and the bond market will lose confidence in U.S. institutions. Either way, we're in uncharted territory. Subscribe if you want to follow this crisis as it unfolds, because we're watching the erosion of the constitutional separation between the executive branch and the Federal Reserve in real time. Drop a comment. Do you think Powell will stay on the board through 2028? Or will he resign? Let me know, and I'll see you in the next one.